This was a very bad day.
We are in the most serious financial crisis in generations.
There's absolutely no reason to expect that prices are going to go back.
I've been effectively unemployed for over a year.
A very, very difficult time, and it's not going to get better quickly.
This is an extraordinary period for America's economy. We are in the midst of a serious financial crisis, and millions of Americans could lose their jobs.
In 2008, the global economy was brought to its knees. Banks failed. Housing markets crashed. Millions lost their homes and savings. How could things go so catastrophically wrong? To uncover the truth, we must go back to the beginning, to an idea that seemed brilliant but ultimately led to one of the greatest disasters in modern history. In the late 1970s, a man named Louis Ranieri had an idea that would revolutionize finance forever. His idea was that banks could bundle home loans, package them as a financial product, and sell them to investors as mortgage bonds or mortgage-backed securities. This allowed banks to free up cash, issue more loans, and grow their profits faster than ever. A seemingly brilliant idea, but one that would later ignite a catastrophe. Fast forward to 2001. After the dot-com bubble burst, the Federal Reserve slashed interest rates to stimulate the economy. With cheap loans available and investors seeking safer places for their money, attention turned to the housing market, a sector that seemed too good and safe to fail. As demand for mortgage bonds grew, Louis Ranieri's idea began to evolve further. Investors who bought these bonds made healthy profits and wanted even more. To meet this demand, banks needed to create more bonds, which meant they needed more loans to package, fueling a cycle of rapid lending and growth. But there was a problem. Reliable borrowers had already bought homes. To fill the gap, banks turned to people who initially didn't meet the requirements to take a loan. Banks started issuing so-called subprime loans, offering loans to people with poor credit, little income, or no down payment. These loans were risky, often given to borrowers who were unlikely to pay them back. But for banks, it didn't matter. They sold these loans in mortgage bonds, passing the risk to investors. The investors didn't care either if the loans defaulted. They could always just sell the house, and due to housing prices constantly rising, still turn a profit. With easy access to loans, housing demand soared and prices skyrocketed. People like Jane, a young woman with bad credit, dreaming of owning her first home, rushed into the market. Afraid of missing out on rising prices, she decided to buy her dream home for $100,000, which previously was considered impossible because of her bad credit. But times have changed due to subprime lending. Jane meets banker John, who reassures her that she doesn't need a down payment. When Jane expresses concerns about her low income, John tells her it's fine to list a higher income on the loan application, even if it isn't true. This is called liar's loans, a type of loan where lenders don't verify the borrower's actual income. This practice increased the risk that borrowers wouldn't be able to afford their payments. To make it even more appealing, John offers Jane a discounted interest rate for the first year. This gives her just enough affordability to proceed. Jane remains worried about what will happen after the discount period when her rate increases significantly. John reassures her again, saying, "Think about how prices are still rising. In 2 years, you'll be able to refinance the loan." Refinancing meant taking out a new, larger loan based on the home's increased value to pay off the old one, often with better terms. In the worst-case scenario, Jane could still sell her house for a profit because housing prices were always rising. Or so it seemed. As for the bank, as mentioned before, It's also fine if borrowers can't repay because the banks sell these loans as mortgage bonds to investors and no longer carry the risk. And lastly, for investors, it was also okay if borrowers couldn't repay. The house could always be repossessed and sold at a higher price for a profit due to housing prices constantly rising. So, win-win-win, right? Do you see the pattern? Everyone is basing everything on housing prices continuing to rise. The bank now packages Jane's loan in a mortgage bond and sells it to an investor, and gets more capital so they can lend to the next person and repeat the process. As more types of loans were introduced, ranging from safe to very risky, a system was needed to assess their risk. This led to the creation of credit rating agencies, which assigned ratings to loans and bonds, a way to measure how risky they were so investors could understand what kind of loans they were buying. This is where the problems began. Banks started mixing safe loans with risky subprime loans and selling these mixed bonds. Since banks were the ones paying the rating agencies, they were incentivized to assign higher ratings than deserved. This resulted in bonds full of risky subprime loans being rated as top tier or AAA. Investors believed they were buying safe assets, which led to even more money being pumped into the risky system. In reality, these assets were much more dangerous than the ratings suggested. This distorted sense of security created a massive ticking time bomb in the financial system, and it was about to explode. Let's return to Jane in her new dream home. She sits in her neighborhood with neighbors who, like her, were given loans despite poor credit. Over time, some of her neighbors began to struggle to pay their increasing interest rates. They were forced to sell their homes. The banks and investors who bought the bonds had anticipated this risk and still received their money because the borrowers sold their houses to pay the bank. But as more and more people sold their homes due to payment difficulties, the market became flooded with houses for sale while fewer people were buying. This led to a sharp decline in housing prices. Jane now sees the market changing. Her house, which was once worth $100,000, has dropped in value to just $50,000. She is now in what's called an underwater mortgage. This means her house is worth much less than the loan she took out to buy it. With a loan of $100,000 and a house now worth only $50,000, Jane finds herself in a difficult situation. If she tries to sell her house, she'll only get $50,000, but she still owes a debt of $100,000. She has no way to refinance the loan because the loan is much larger than the current value of her house. As homeowners like Jane, who couldn't afford their loans, began missing payments on subprime loans, housing prices fell, and the losses spread through the bonds. This caused investors to lose confidence in the value of the bonds and the credit ratings. Investors started selling off their bonds in panic, but it was already too late. The value of these assets was dropping faster than anyone had anticipated. What was once considered safe investments were now seen as ticking time bombs.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on.
Where'd you get your bonds? What's the point to scream? Where?
Now we see the entire financial system shaking at its core. Banks that were once considered secure
Brokers and traders fought to minimize the impact of Lehman's collapse. The damage had already been done.
began failing. They were full of bad loans and worthless bonds. The institutions that were supposed to be the cornerstones of the economy were themselves becoming victims of the collapse they had helped create. Millions of people lost their jobs, their savings, and were left homeless. What began as a brilliant idea had now turned into a gigantic house of cards. A house of cards that collapsed and brought down the entire global economy with it. After the financial crisis reached its peak in 2008, the global economy was on the brink of collapse. It was at this point that governments stepped in to try to save the situation. The US government poured enormous sums of money into rescuing some of the largest banks and insurance companies. It was an effort costing hundreds of billions of dollars to prevent the entire financial system from collapsing. The goal was to stop a total economic disaster. Despite the rescue efforts, much went wrong. Many of those responsible for the crisis, such as executives and financial players, escaped without significant consequences. This created widespread anger and frustration among the public. After the crisis, governments introduced new regulations to try to prevent something similar from happening again. Despite these changes, concerns remain. Some of the rules introduced after the crisis have since been softened or eliminated, and many wonder if we have truly learned anything.